How's it going, friends and family? Today, let's go ahead and talk about Oracle Corporation. So what exactly is Oracle Corporation and how do they make revenue? It's a dinosaur B2B tech company that operates Oracle database, software licensing, and their most recent endeavors in cloud infrastructure, also known as OCI. And for what it's worth, Oracle has been the most popular database management system for 12 years in a row. But what's funny is, based on my research, a lot of IT engineers, they cannot stand Oracle. However, it's what their firm or company uses, so they just have to deal with it. And when we think about what's going on with Oracle lately, well, they just reported their earnings and it was a hot situation. The Wall Street's starting to worry that all the AI spending, it's not going to have a positive ROI because they're always really short-sighted, greedy, and they want to see instant gratification. They don't care if you have a long-term game plan and a vision and it takes years to roll out. They want to see results right now. But it also might have to do with the fact that Oracle's spending billions on NVIDIA chips and billions on networking equipment in order to make new revenue with their pivot into cloud and AI platforms. About $100 billion of expected capital expenditures. That's money that you are going to directly eat in order to build out new data centers, in this case for Oracle. That's a lot of money, $100 billion. But circling back to their earnings report, their revenue came in short of expectations because their legacy business dropped by 3% year over year. But management reiterated its full year revenue guidance of $67 billion. They didn't raise it, they said, okay, hey, pump the brakes, we're going to be able to be good on that $67 billion that we forecasted earlier this year. So in the end, does it really matter? Their revenue is going to be $67 billion for fiscal year 2026. Right now, they're operating in Q3 of 2026 as their fiscal calendar looks a little different. So what I'm trying to say is that their legacy business, the revenue is declining, but their OCI revenue was up by 68% year over year. And this is a huge catalyst, okay? OpenAI, the parent company of ChatGPT, they just signed a contract with Oracle to buy $300 billion worth of cloud computing on Oracle's OCI. So $300 billion over the span of 5 years, starting around 2027. If you do the math, that works out to about $60 billion of revenue just from OpenAI, because when you put it into perspective, for this 2026, they're only expecting $67 billion, and that's without the OpenAI revenue. And after digging around, I found out why OpenAI wants to partner with Oracle. Because if we're going to be honest with one another, Oracle, they're not best in class when it comes to the cloud space. I would argue AWS, Azure, and then even Google Cloud, they're top 3. Oracle, they're like in the top 10, but not towards the top 3. Reason being is that Oracle has priority in the waiting line for the highly coveted NVIDIA chips. Because there's a shortage of it, right? There's only a finite supply, and not everyone can get it. But Oracle's been waiting in line, so they have priority. And at the end of the day, OpenAI needs access to those GPUs in order to support their growth. So it's one of those things where it's like, if you scratch our back, we'll scratch your back. Now, I'm not trying to be the kind of guy that goes over to your house for Thanksgiving dinner and blows up your toilet with like massive diarrhea, but between you and me, nothing about that deal makes any sense. Because when you think about it, do you really think OpenAI has $500 billion to pay Oracle right now? No, I don't think they do. They're not a publicly traded company, so we don't know how much capital they have, but I'm almost certain they're going to have to take on loans in order to finance that $60 billion per year. And when you think about Oracle, like I just alluded to, they're a small dog in the cloud fight. They don't have optimized operations or the bandwidth to support OpenAI right now. So I guess that's why when it comes to the AI movement, they say that you have to spend a crap ton of capex in order to stay relevant. Earlier this year, Microsoft said, hey, we're going to be increasing our capex, and their stock price got slaughtered. Same thing happened with Amazon, same thing happened with Google. Listen, I'm not trying to be overly optimistic, but when it comes to the future and cloud and AI, I think planting the seeds today, spending what, 50, 60, 70 billion dollars in order to increase your bandwidth for the future, the ROI is going to be massive. And that's why when Wall Street punishes these companies, for doing more capex and they go on a sell-off, I don't blame you if you dollar cost average, because that's temporary noise, because in the grand scheme of things, they're going to be amplifying their revenue by like 100, 200, 300% because now they have more data centers. Does that make sense? Case in point, when you think about Google and Amazon, they literally had to build out more data centers because they were saying like, hey, we don't have the capacity right now to take on more customers or to meet their needs. So we have to spend this money so we can acquire more customers and to allow existing customers to increase their bandwidth. So instead of throttling them at like 100 terabytes, now we can give them access to 10,000 terabytes or XYZ. For me, I get bullish, okay? But I'm not naive either. I think that's absolutely the narrative and argument for why we are living in an AI bubble. All this big money is literally just going in a circle until one of them pulls up their pants and says, I'm done circle jerking with you guys. This is just outrageous. My $70 billion is going over here, and then that $70 billion is going over here, and then it just repeats that cycle among like 10 to 15 companies. So AI bubble, I think it's a thing, but hey, the difference between this and the dot-com bubble crash is that it's actually generating cash and revenue and value for not only the investors, but also their clients and customers. Whereas the dot-com bubble crash, almost 90% of those companies were unprofitable. They weren't even real. It was kind of like the SPAC frenzy in 2020, 2021. A lot of these companies were just like, hey, we're gonna make a website about this. By the way though, pets.com, I think they were just 10 years too early. Because today we have stuff like Chewy.com and Amazon.com. Ordering your pet's needs online, they were just a little ahead of their time. So good business, just poor timing. 1999, the year 2000, they got slaughtered. Speaking of which, I promise we'll circle back to Oracle, but I'm a shareholder of Cisco. However, having said that, if you bought into Cisco during the dot-com bubble crash, in, April 7th, the year 2000, it would have taken you 25 years to break even and then finally be into the green, only when you take into account the share price appreciation. Obviously, if you bake in the dividends that they paid out throughout the years, you would be in the green. But dude, buying a stock during a bubble, it could take you realistically decades in order to get a positive ROI. Just something to digest and marinate, and then you can defecate later. So let's talk about the cheese situation. On a high level, what are the factors that you need to take into consideration when it comes to Oracle? Number one, Oracle manages the data that keeps daily operations running. I'm talking about if you switch on over to a competitor or to a peer, it's going to be highly disruptive and time consuming. I'm referring to their legacy business model of database management, but also their software licensing. And this is not hypothetical. Based on my research, not too long ago, Amazon and Alibaba, okay, they're huge tech conglomerates, right? It took them over 5 years in order to fully migrate off of Oracle. So when you think about other large enterprises that are not as capable as Amazon and Alibaba, it's not gonna be a quick project. So having said that, once Oracle manages your data, it's gonna be a pretty sticky customer. Point number two, right there, I have $523 billion of Oracle Cloud infrastructure backlog. And that's money that Oracle will earn once they're good on their end of the bargain and build out the data centers for NVIDIA, Meta, and OpenAI. So we're talking about the biggest hitters in the game partnering with Oracle. If we were talking about some dingy startups that are burning cash and are unprofitable saying, hey, Oracle, let's high five and do an Eiffel Tower right here, then, it's okay to be skeptical. But when we're talking about the top dogs, the hyperscalers trying to do business with Oracle, $523 billion in their backlog of revenue potential sounds pretty good to me. However, on the downside, when you think about it, their balance sheet looks the worst out of all the cloud giants. When we talk about Google, Amazon, Microsoft, their balance sheet, we'll talk about it later and look at it together, horrific. And as of right now, they're free cash flow negative because of the required capex in order to change their game plan, going from their legacy business model to what they are trying to be today, OCI. So at this point in the video, I'm going to be sharing with you my homework and research to what I believe is the inherent worth for Oracle's stock price. So based on the multiples valuation, Oracle should be valued at $183 a share. And at the time of making this video, the Seahawks are playing the Colts, by the way, As of right now, they're $189 a share. Their PE is a 35.7. So, according to the multiples valuation, Oracle is slightly overvalued or fairly valued because we're talking about plus or minus like $5. But the multiples valuation, it does not take into account or bake in their future growth potential. $500 billion. And that's why I'm personally not a fan of using the multiples valuation or the grams valuation or even the dividend discount model. Instead, I've been using this earnings forecast calculator that I made because I think it's a little more accurate and it takes into account their bottom line improving contingent upon their business operations. So, having said that, what you see up above my head are the earnings that they reported for Q1 and Q2 of this year so far for them. They're in fiscal year 2026. For Q3, I'm proposing $2.15. For Q4, I'm proposing $2.25, which means they should wrap up 2026 at roughly $7.51 for their profits per share. The EPS is essentially the bottom line per share. Having said that, I think they're going to finish out their fiscal year at a PE of a 35, which means they should be valued around $262.85. However, if the narrative switches and people start to be bullish towards Oracle again, because mind you, a couple of months ago, they were $345 a share. Okay, so is it too outrageous and diabolical for me to suggest and insinuate that maybe the markets could be bullish about Oracle again? If their PE jumps up to a 45, then Oracle could realistically be $337 again. To reach that 345 or 350, the PE needs to go above like a 50-51. And if we jump on over to the next year, I think their cloud endeavors are going to continue to gain traction and the revenue is going to continue growing at a pace of like 20, 25, or even like 40% year over year. And that's not taking into account the huge data centers that they're currently building out right now. So I think 9% increase in their EPS seems very modest and humble, but realistic as well, okay? Now, if that is the case and they post $8.19 for the EPS, and with a projected PE of a 38, why is the PE going up? Because as Oracle's leadership gives a briefing and a status update to their data centers like, hey, we're 60% done, 70% done, I think every nipple on Wall Street's gonna get perky once again, okay? So their valuation is gonna jump up in line with their execution. If that is the case, $311 in roughly a year and a half from now should be the fair valuation for Oracle. And just in case you're picking your nose or you're scrolling on TikTok as you're trying to listen to this video, they're currently $180 something a share. So if you take a look at their price forecast, I do think they're undervalued right now, especially for what they're trying to pull off and execute. But anyways, with a bullish PE of about a 50, which I certainly think is okay for a company that's about to bring in $500 billion of revenue in the next few years, Oracle could be $409 a share. Now in 2028, let me bridge the gap. You might be like, dude, you're ridiculous. You're an idiot. What are you wearing? You don't even know what you're talking about. Fair argument. And you're probably a San Francisco 49ers fan. Mind you, I have a master's degree, darn it. But anyways, I'm proposing that their bottom line per share is going to just Shohei Ohtani grand slam out of the ballpark because that's when they'll start raking in the money from the hyperscalers. Right? Because they're going to finish out the data centers for the hyperscalers by the end of 2027, which means they're not really going to see that revenue until Q3 2027 at the earliest, realistically around Q4 2027 or Q1 of 2028. Now, having said that, I think their revenue is going to be off the charts and their bottom line is going to follow suit because their margins after they build out everything, it should dramatically increase, right? So I'm thinking $11.05 for 2028. And their PE is going to be a 40 because they're not only supporting OpenAI, but they'll also be supporting NVIDIA, Meta, and I'm sure the other Mag 7 people will jump in as well, which means $442 a share in roughly 2.5 years from right now at the time of making this video, if everything rolls out according to plan. Now, we live in reality. I'm grounded in Murphy's Law. Things could go south. They could have setbacks. They could have project managers quit on the spot. They could have equipment malfunctioning, and Oracle might not roll out their data centers on time. Okay, that could happen, all right, realistically. However, If we're just going to be thinking optimistically and everything goes according to plan, in a bullish case, PE of a 55, then I think Oracle could be $607 a share. Now, I don't know about you, but that upside from 180 whatever a share they are right now to 600 sounds pretty good. But even on the low side of 442, you would essentially 2x your money. And if we jump on over to 2029 and we play this exact same game, then I think Oracle could realistically be $460 a share in the next 3.5 years. So according to their earnings forecast, predicated upon what they are about to achieve with the $500 billion that are about to come into their pockets, I think this figure right here is a lot more accurate than the $183 that we saw in the multiples valuation. So there's no way to spin it or manipulate it. On paper, based on their numbers and fundamentals, I think Oracle is undervalued. But if things go south and they have setback after setback, they could also hit like $100 a share, right? The possibility is out there. And for the next inherent worth calculator, dude, I'm so freaking excited to show you guys because I've been working on it for the past couple weeks, and I think it's finally good to go. I've been troubleshooting it. I've been throwing wonky numbers at it to see if they can respond and spit out a coherent number. And it's been working. So friends and family, I present to you the Amos GARP formula, and it's going to be predicated upon future revenue growth. And yes, you wise guy, I took a lot of inspiration from the discounted cash flow analysis model, but instead with the revenue. What is the cheese value per share that they should be right now? $378 a share. Now, if we jump on back over to the earnings forecast calculator that I also made, that would put the valuation of Oracle somewhere between $311 and $409 a share, which is the forecast for 2027, or roughly a year and a half from now. And to be fully transparent with you, because I created this bad boy, I'm gonna be featuring it a lot in upcoming uploads. And I'll be posting it onto the Patreon if you wanna play with it. Exclusive for only the Patreon folks. Now, having said that, if that's the cheese value per share, then what's the price that I would pay once you bake in a margin of safety? That way you buy it at a discount instead of buying it at the value they should be. But if you buy them with a discount baked in, and they're trading for like $200, then the upside from 200 to their fair value of 370 is a lot better, right? I don't know, it's just the way that my brain is wired. It's really small, by the way. So if Oracle is truly valued at 378, then the price that I would pay in order to have them be a part of my portfolio is 264. Exactly. You're probably like, what? They're $180 something a share. That means they're massively undervalued according to the Amos GARP formula. I could be wrong, but it's just what I'm saying. So according to the earnings forecast and the GARP formula, it does seem like on paper, predicated upon that $500 billion that's going to be coming their way, they are undervalued. Could be wrong. This is not fundamental truth. I'm an idiot, okay? So when it comes to Oracle, where am I going to place them when it comes to the compounder chart? The left side means they're a certified compounder. My money invested into them is going to compound 1, 2, 3, 4, 5x given a certain amount of timeline. On the right side is the Kager graveyard, the F tier. Chime Finance and Carter's baby's clothes. Your money invested into it, probably not the wisest use of the capital, right? All right, having said that, I think with Oracle, it's a classic example of long-term bullish fundamentals running headfirst into short-term financial anxiety. They're spending a crap ton of money changing the trajectory of their business model. And the facts are, their vision, in order to execute that properly, it's going to be very expensive, time-consuming, and their margins are also going to be straight doo-doo for the next few quarters. And that's why I'm thinking their stock price right now at 180 might not be a good deal because they can continue to dip further and go into the red week after week, at least for the next 2 quarters, because we already know their free cash flow is just going to get worse and worse. Having said that, I think 2 years from now, once those data centers are up and running, I think it's going to be a compounder. So I think of Oracle the same way that I think of Adobe, the same way that I think of the Trade Desk, and of course, Texas Instruments. It's a C+. I don't think they should be on the same tier as Salesforce and United Healthcare, but it is still a solid company. And as of right now, their trading multiple is at 35. Their forward PE ratio is at 26. And I kind of wanted to talk about their legacy business because I also think it prints cash, even though it dipped ever so slightly, okay? I mean it when I say they're an ancient dinosaur tech company like IBM and Cisco. They always just seem to find a way to stay relevant. But when you think about their legacy business model, they were responsible for the back-end database software that's critical to the day-to-day operation of almost every organization in the S&P 500. And just like Salesforce, once you have a contract with Oracle, very sticky and there's very high switching costs, so you usually tend to just stick with them. Remember Amazon and Alibaba? Dude, it took them almost 5 years to pivot away from the Oracle ecosystem. Think about it. The database of a company is usually the central nervous system. Or in other words, it's your brain. If you get rid of your brain, you're kind of obsolete, right? So the database of information that Oracle software helps you to manage, it includes all of the flight information for an airline, or even the stock market trading volume for the New York Stock Exchange. And as a company, you really wouldn't want to switch database providers unless you really have to, because you want to avoid going offline for business continuity and operational risks. Even going down for 24 hours, huge implications and setbacks. Now, the catch is, with their legacy business model, their customers build their own data centers and then install the Oracle software on their own servers. And that's why they're pivoting away from that style to where Oracle does everything, a one-stop shop, into Oracle's OCI. The Oracle Cloud Infrastructure. That way their existing customers can just easily transition and have all of their information on Oracle's data centers instead of operating and running their own. I don't know. I feel like it might be more efficient to run your own data servers, but I'm also not an IT guy, so what do I know, okay? So they're basically turning into an AI infrastructure utility company. If you want your lights on, you're gonna have to pay Oracle. So when I think about their business model going forward, it makes sense. And when you think about their revenue situation, I think leading up to 2022, they were pretty much flat and not that desirable of a company. Okay, that was a huge lie because it did grow from $37 billion to $42 billion, but it wasn't really getting amplified. However, for the past 2.5 to 3 years, you can see that they're really scaling their growth and they're becoming a growth company instead of just being a safe and steady player like IBM was, right? Even they just switched their identity not too long ago. If I jump on over to their balance sheet, this is what I want to talk about, okay? So as of right now, they have $19.7 billion of cash and cash equivalents on hand, but when you compare that to what they were historically, 2021, $46 billion, in 2018, $67 billion, but they're spending a crap ton of money on the books in order to make this whole data cloud pivot come into reality. So that explains why that's happening, but this is where it gets really horrific, okay? Take a look at their total debt situation. You want to see a mature enterprise, even if they're in the hyper growth category, you don't want to see their total debt be scaling faster than how much revenue they're generating, right? As a general rule of nipple. Sometimes there are exceptions to that rule, but in 2016, $44 billion of total debt. That takes into account the long-term obligations of like 20, 30-year loans, but also the short-term stuff that's like 3 or 5 years out. $131 billion of loans on the books. That's not a fact that you can turn a blind eye towards, right? If we jump on over to the debt to EBITDA ratio to figure out if it's sustainable or not by taking into account their core operating profits, a 4.6. It would take Oracle roughly 4 years and 7.5 months in order to pay off the loans on the books if everything else were to remain the same. And I'm going to be honest with you, for a tech company, that's really freaking high. Because usually the debt to EBITDA ratio for a tech company that's doing cloud and software, usually like a 1 or a 2. The golden standard, like having a 20-inch dong or a size 14 shoe, is a 3 or less. To see a 4.6, alarmingly high. So their debt is scary, but you have to remind yourself of the fact of $500 billion of potential revenue on their backlog. If I jump on over to their cash flow statement, I'm not exaggerating when I say their free cash flow situation right now is absolutely horrific. Leading up to 2024, before they started pounding billions of dollars into capex, $11.8 billion. The trailing 12 months, friends and family, $13.1 billion negative free cash flow. So they're spending more money than they generate in order to keep their operations thriving and the lights on. That's really scary. The biggest culprit, as you can see, is the capital expenditures. It's only getting bigger and bigger since 2022. Like, I'm talking about guppies in a fish tank. It is just, amplifying at a rate that is pretty terrifying. But it makes sense. They're going to be spending upwards of $100 billion of capex by 2027 in order to make this come to life. So it's one of those things you need to take into consideration, like, are they truly going to be best in class and one of the big hyperscaler supporters? Or will OpenAI and their other customers just jump ship and go to Amazon or Microsoft, right? That is something to also put in your filthy little mouth, swish around and think about. So when it comes to Oracle, I definitely think this is a company that I'm going to be putting on my watch list, but at their current price point, I don't think I'm going to be buying in. I think I'm going to wait for them to further dip or show a hint or a sign that they reached the bottom. Then I might entertain the idea of jumping in, but at 189, I'm not going to do it. Because if you think about it, their April lows was roughly like what, $118 a share. So who is to say they're not going to reach 150, 120, or even $100? I'm telling you right now, if Oracle goes down to $100 and nothing else changes from what we just gathered in this video, I'm going to go all out. Okay, but if they go to $100 a share because new information comes to surface or they reveal a big setback in their operation, then of course I'm not going to do it, okay? And before you sign out of here, amigo to amigo, I usually give you guys a glimpse into the personal life because you guys are my friends. So I'm a first-time dad. The baby girl just hit 8 weeks old. Pretty crazy to see the growth, especially going from like 6 pounds to roughly like 10.5 pounds is really wild. But to be completely transparent with you, I don't think I was mentally prepared for how hard and difficult it would be to keep her alive, thriving, and happy. The amount of sacrifices that you need to make, it's pretty mind-boggling. So dad life has me completely exhausted. Now, obviously, I could be hands-off and not involved and not help at all, make my life easier, but dude, I'm trying to be different, right? I'm trying to break the generational trauma curse and try to do things differently. So I realized as I have been editing my videos, if I'm a little off or if I'm not funny anymore, it's because, dude, I'm literally so freaking tired. I'm sleep deprived and I haven't had a good night's sleep in roughly 2 months. So I don't know if you're in the know or not, but here in Japan, dude, we've been getting smacked in the butthole with earthquake after earthquake almost every 20 to 40 minutes. So you combine that with a baby crying throughout the night, and do you think you can get any sleep? It's been rough, okay? But somehow, with the way that my ADD is set up, I've been crushing books whenever I get a chance. To just take my bra off, I will just curl up on the couch with a book. Now, reading a book isn't something that I usually gravitated towards in the past because I was always on the go, trying to pump out the next video or analyzing the next stock, and my brain was really active. But now I'm at a point where I'm like so tired. The energy level is so low that a book sounds pretty good, right? Very recently, I finished Dark Matter by Blake Crouch. Actually, that was a lie. I finished it a few months ago, but it doesn't change the fact that the book was insanely good. So if you want a legit page turner, grab that one. I'm telling you right now, if you're trying to get into reading, but you don't know where to start, Dark Matter by Blake Crouch. You're talking about different time dimensions and changing your past. Do you ever think about like what ifs and regrets and remorse and nostalgia? That book touches upon all of those topics. But as of right now, dude, I'm reading a murder mystery, a thriller. So freaking good. So having said that, if you have a book recommendation for me, I'm down. I'm at a point in my life where I want to read books. It's like a nice way to relax. And something else that no one really talks about is when you introduce a baby into a household that already has 2 fur babies in the form of like cats or dogs, right? Like I feel so bad for them. Because prior to the baby arriving, our dogs used to get our undivided attention. We used to pamper them, play with them all the time. We're talking about taking them with us whenever we went out in the car. Every grocery trip, every vacation, every whatever, here up and down the Japan island, the dogs came with us. But now, our hands are full, right? We're in the newborn trenches taking care of our baby daughter. So the dogs, they've been kind of on the back burner, right? It's been up to me to take care of them. And I noticed, dude, I just feel so bad, right? I can see, I guess, the hurt in their eyes because they're noticing that mom and dad is paying so much attention to this tiny little creature that they're not really friends yet or bonding yet, right? It's too new. So I've just been petting them twice as much and trying to just comfort them as much. Like whenever I have a shirt that I wore the day prior, I will take that off, and before I throw it into the laundry basket, I'll drape it over them when they go to sleep in their little kennels. That way they can at least smell me throughout the night, and I just pet them more and more. And a fun fact about me is that I'm allergic to dogs, so I can't actually touch them with my bare hands. I have to put on gloves, and then I pet them. Like in the past, I'd probably spend 15 minutes a day petting them. Now I spend probably 40 minutes a day petting them. So it is an interesting dynamic, but it's because I have one dog. His name is Bernie. He's a Cavapoo. He gets stressed out really easily to the point where he has really bad health complications whenever he gets too stressed, introduced to a new change that he's not good with. So I've been paying extra attention to him. So yeah, that's my life in a nutshell these days. And yes, I'm still trying to run that marathon. It's just I've had some setbacks in my training regimen because, I don't know, my right leg's been hurting quite a bit. And I have flat feet to make matters worse. But I will document and vlog and film myself running a half marathon. And then eventually we'll do the full marathon. Okay, well, anyways, I'm talking too much. Can't wait to watch the Seahawks putting the Colts into a chokehold. Or I don't know, by the time this video is up, maybe the Colts will win. I don't think they're going to win. Dude, they have a 44-year-old quarterback who's been retired for 5 years, Phillip Rivers. I don't think he's going to be able to get over 150 yards of passing, but I truly am rooting for the guy. If he throws a touchdown pass, I will clap for him. I will celebrate him. But at the end of the day, you got to root for the Seahawks, right? So anyways, I appreciate you guys. I love you. Stay safe. Good luck in the stock market, and I will talk to you really soon.